Welcome to the Deep Dive. Our mission today, well, it's really about extracting the signal from the noise. We're looking at a stack of sources showing these really conflicting messages in the global economy.
Absolutely. It feels like everything's happening at once.
Exactly. How corporate strategies, the big layoffs, the AI push, and these major political headwinds are all kind of converging right now.
Yeah, you've got this massive corporate belt tightening. Think Amazon's huge layoffs. But then those same companies are pouring billions into AI. It's quite the contrast.
And then the politics.
Right. You layer on the real cost of tariffs hitting shoppers, plus, the policy gridlock that's causing immediate actual disruption, like grounded flights.
So our job for you, the listener, is to connect those dots. We want to pull out the specific data points that help explain why things feel so, well, unstable, why your flight might get canceled, or why your online shopping costs more.
Making sense of the chaos, basically.
Let's dive right in then. Let's unpack this diverging consumer picture. We've heard the fast money folks debating it, and the sources show this really clear pricing hierarchy emerging across big retailers. And it seems like tariffs are the key driver.
Yeah, the data here is fascinating. It really highlights how different company structures handle these costs. Who absorbs them versus who passes them straight on to you.
DataWeave did this analysis, right? Looking at online prices from, January to September 2025?
That's the one. And the split between the big retailers is really stark.
Stark is putting it mildly. Amazon prices, on average, across the items they looked at, went up 12.8%.
12.8%.
Now compare that to Target, up 5.5%, and Walmart, up 5.3%. That's a massive difference.
It really is. And there's a quote from the research that just nails it. Prices rose fastest where consumers shop by choice, not necessity, and most cautiously where they shop by need.
Okay, hold on. If the tariffs apply broadly to imported goods, why is Amazon hiking prices more than twice as much as Walmart or Target? Shouldn't everyone be feeling the pinch similarly?
But that's where the business model makes all the difference. It's about structure. Amazon's platform relies heavily on third-party sellers.
Right. Millions of smaller businesses.
Exactly. And those smaller sellers are, quote, far more exposed to tariff-driven cost increases. They just don't have the scale, the private label options, or the complex supply chains that giants like Target and Walmart use to, cushion the blow or absorb costs.
So for those sellers on Amazon, there's less wiggle room. They just have to pass the cost on.
Pretty much. They don't have the same levers to pull, so you, the shopper on Amazon, end up seeing those tariff costs reflected much more directly and quickly.
So the policy hits everyone, but Amazon's structure means it hits the consumer harder and faster there. We're seeing the corporate impact too, right? Like in cosmetics, of all places. ELF Beauty.
Oh, yeah, that's a really stark example. Their earnings report showed profitability was, quote, crushed by the new tariffs.
Crushed. How bad was it?
Net income fell 84% in their fiscal second quarter. 84.
84%. In one quarter. That's just catastrophic.
Yeah.
Is that purely tariffs?
The report attributes it directly. Their gross margin dropped 1.65 percentage points, and they explicitly linked that primarily to tariff costs. So, yeah, not a demand problem, purely a policy-driven cost increase hitting their bottom line hard.
And this ripples out, doesn't it? It's not just physical goods. It hits the digital ad market, too.
Exactly right. Look at Pinterest. Their shares tanked, 21%?
Yeah, 21%.
And the reason they cited was tariff-related ad headwinds. Basically, those big retailers, the Walmarts and Targets, even though they were trying to shield consumers somewhat, were still feeling the margin pressure from tariffs.
So they pulled back on advertising spend.
Bingo. Pulled back on digital ads on platforms like Pinterest. It's a chain reaction. Tariff pressure leads to margin pressure, which leads to cuts in spending like advertising.
And bring this back to the big picture, inflation. The Federal Reserve actually quantified this, didn't they?
They did. They estimate that these tariffs are adding roughly 0.5 to 0.6 percentage points to the core PCE price index.
Which is the Fed's preferred inflation gauge.
That's the one. So when the Fed itself says this specific policy choice is responsible for over half a point of inflation, you realize, okay, this isn't just theory, it's a measurable hit.
A measurable hit indeed. Okay, so that economic cost leads us directly into the policy risk itself. Two huge stories out of Washington causing immediate stress. First, the Supreme Court actually challenging the legality of these tariffs.
Yes, and this is a fundamental challenge. What's really interesting is the skepticism wasn't just from one side of the bench. Both conservative and liberal justices seemed, well, deeply skeptical.
About the reciprocal and fentanyl tariffs specifically.
Those are the ones in question, yes. And the core legal argument is about the president's use of the International Emergency Economic Powers Act, the IEEPA.
Right. The act that lets the president regulate commerce in an emergency. But the argument is that using it for these tariffs oversteps presidential power.
Exactly. That it infringes on Congress's power to tax. Because, let's face it, tariffs function like taxes.
And the justices picked up on that directly.
Oh, yeah. You had Justice Sotomayor basically saying, you say tariffs are not taxes, but that's exactly what they are. Pretty blunt.
And Justice Gorsuch raised a point about ceding power.
He did. He questioned how Congress ever gets power back once it delegates it under something like IEEPA. He called it a one-way ratchet.
A one-way ratchet, that's a potent phrase, implying power flows to the executive but rarely flows back.
It really captures the constitutional concern about eroding checks and balances. And the financial stakes here are just massive.
Treasury Secretary Bessent warned about refunds.
He did. Said the U.S. might have to refund $750 billion or more if the court rules against the tariffs, especially if they delay the decision until next summer.
$750 billion. Wow. That's a potential fiscal time bomb.
It absolutely is.
So while the Supreme Court is grappling with the legality of past policy, we have this immediate crisis from current policy gridlock the government shut down, the longest ever. Right, 36 days.
36 days. And the fallout is hit in the skies, literally. Transportation Secretary Duffy announced flight cuts.
A 10% cut in capacity at 40 major airports. That's huge.
It translates to something like 3,500 to 4,000 flights affected daily.
Yeah.
And the reason isn't weather or equipment.
It's staffing, right? Air traffic controllers missing paychecks.
Exactly. Insufficient staffing, safety concerns, all stemming from the shutdown, and controllers working without pay. Morale is obviously terrible.
And the union head, Nick Daniels from NCA, warned this isn't just a temporary blip.
No, he pointed out the system was already short thousands of controllers before this. Now, with burnout and safety worries, he said recovery could take weeks even after the shutdown ends. There's real concern about controllers just resigning.
So that political gridlock translates directly into, well, travel chaos for potentially weeks to come. You can't just flip a switch and fix this.
Definitely not. And politically, you saw the immediate fallout, too.
Right, the recent elections. Democrats swept key races, New Jersey, Virginia governorships, NYC mayor.
And President Trump's reaction was telling. He blamed the losses on the shutdown itself and, him not being on the ballot, then immediately went on the attack against the new NYC mayor-elect, Zohran Mamdani.
Calling him a communist. It just shows how tangled policy failure, political blame, and future election strategy are right now.
Completely intertwined. Okay, so let's pivot from that D.C. chaos to the corporate world. Because there we see this really striking paradox playing out.
Which is?
Companies are making the biggest cost cuts ever, think massive layoffs, but at the same time, they're making incredibly aggressive, expensive bets on the future, mainly AI.
Amazon seems like the poster child for this. Jassie's overhaul? The scale of the cuts is unprecedented for them.
Totally. Over 27,000 jobs cut since late 2022, with 14,000 just announced recently. The stated goal is efficiency, to flatten our organization.
Operate like the world's largest startup, I think was the phrase. Increase the ratio of individual contributors to managers.
Right, by at least 15%. Get leaner, essentially, to free up resources. But the impact on the people still there is intense.
You hear reports of incredible amount of pressure, people doing more work.
Yeah, and the internal reaction seems pretty cynical. Employees are apparently mocking the corporate changes with memes about staying nimble.
Staying nimble, right. Code for do more with less. It perfectly captures that tension. Slash costs here, pour money over there.
And that money is flowing overwhelmingly into AI. We're seeing companies place huge bets, and some are already showing results. Take Figma.
The design software company.
Yeah, they beat expectations. And part of that was their generative AI tool, Figma Make. Apparently, 30% of their big clients, the ones spending over $100K a year, are using it weekly.
30% weekly use is pretty sticky.
It is, and their CEO was explicit. They're investing heavily in AI and will, quote, trade near-term margin for long-term platform dominance, sacrifice profit now for growth later.
We saw a similar big bet from Snap too, right? Their stock jumped massively.
Jumped 25%, yeah. boosted by a huge deal, a $400 million one-year contract with Perplexity AI
$400 million for 1 year. What's that for?
to integrate conversational AI search directly into Snapchat starting in 2026. That's not tinkering, that's a massive strategic investment.
And the chip makers are obviously riding this wave.
Qualcomm beat earnings, gave a strong forecast. And significantly, they announced they're pushing hard into AI accelerator chips, the AI 200 and AI 250 for data centers coming in 2026, 2027.
Taking aim at NVIDIA and AMD.
Clearly, diversifying beyond phones into the booming AI chip market. But not everyone's thriving. Look at HubSpot.
Their stock is down quite a bit this year.
Down 34%. Investors are worried AI could disrupt their core business. So HubSpot's trying hard to counter that narrative, positioning AI as a positive catalyst, even bringing Meta's head of business AI onto their board, trying to signal confidence.
It's adapt or risk falling behind. We also saw Robinhood successfully diversifying.
Yeah, they doubled revenue, beat earnings, not just from trading, but they've built up new lines. Prediction markets, wealth management, crypto through acquiring Bitstamp.
And those new businesses are generating real revenue now.
Reportedly, $100 million or more in annualized revenue. It shows a successful pivot, reducing reliance on just retail trading volatility.
Okay, so this massive corporate restructuring, the AI focus, it all leads to this fundamental question about energy. The whole global conversation seems to be shifting.
It really is. What we heard coming out of the recent ADIPEC summit marks a pretty profound change in framing.
The key shift being from energy transition to energy addition. Explain that difference, because it sounds subtle, but it feels important.
It's crucial. Transition always implied moving from fossil fuels to renewables, phasing one out for the other.
Like swapping your gas car for an EV.
Right. But energy addition acknowledges we need to develop renewables in parallel with existing fossil fuels, maybe even expanding some fossil fuel production, just to meet soaring global demand.
So it's not just swapping the car, it's needing the EV and needing way more power generation overall from all sources to charge it and power everything else.
That's a good way to put it. It's an all-of-the-above approach driven by reality. OPEC's Secretary General, Haytham El-Ghais, actually said the shift to a balanced approach was music to my ears.
Because just a few years ago, the dominant message was get rid of fossil fuels.
Exactly. He noted that dramatic shift in tone. And the demand drivers are undeniable. You've got 1.5 billion people urbanizing globally, needing more power.
Plus, the absolutely massive energy draw from AI and data centers, that's expected to grow fourfold by 2020.
Fourfold. It's staggering. And then add manufacturing demand on top. So the outlook reflects this. The UAE's Minister Al Jaber said LNG demand is set to grow 50%, oil demand likely staying above 100 million barrels a day.
And experts like API's Mike Summers and S&P's Dan Yergin are echoing this, saying a big rethink is going on.
Yes, it's a pragmatic reassessment, which leads consultancies like Wood Mackenzie to say, look, the specific goal of net zero by 2050 to hit that 1.5-degree warming limit, that's probably dead.
That's blunt.
It is, but they add that the broader direction, the shift towards lower carbon, more renewables, more EVs, that momentum is still very much alive. It's just the timeline and the pathway that are being radically rethought.
And this need for massive, reliable power brings us back to policy and infrastructure again, specifically nuclear power.
Right. The Trump administration just finalized that huge $80 billion deal with Westinghouse
to build large AP1000 reactors. The implication being these are needed for that surging electricity demand, potentially from data centers and AI.
That seems to be the strong implication. And what's really interesting about this deal is the financial structure. There's a provision that could make the U.S. government an 8% shareholder in Westinghouse if the company goes public by 2029.
The government taking an equity stake in a nuclear company.
Potentially, yes. It shows how governments might get directly involved, even through ownership, to secure the energy infrastructure needed for these massive future demands, particularly AI.
Okay, so if we pull back and look at everything we've covered today, it's this landscape of simultaneous pressures. You've got the tiny, sharp pressure of tariffs hitting specific company margins, leading to layoffs.
Right. Then you zoom out to the massive corporate restructuring those layoffs, funding huge bets on an energy-hungry AI future.
And all of this is happening while the fundamental global conversation about energy is being rewritten by this incredible demand surge from data centers, AI, and urbanization.
It really leads to a final, maybe provocative thought for you, the listener, to chew on. We're seeing this rare moment where immediate political dysfunction is the shutdown, the tariff legal battle is creating tangible problems in your daily life. Flight cuts, price hikes, you can see.
At the exact same time.
At the exact same time that corporations are making these enormous long-term structural changes for a future that demands vastly more reliable energy. So the question becomes, if the political system is struggling right now just to keep basic functions like air travel running smoothly, how confident can we really be in its ability to manage the incredibly complex long-term energy overhaul needed for this energy addition era?
That is definitely something to think about as all these forces collide. A huge amount of change happening all at once. Thank you for diving deep into the sources with us today.